Welcome to the Residential Wrap that covers the key and ongoing stories we are following the first week of March 2026. I'm Sarah.
And I am David. 43% of all residential building plans passed nationally last year came from one province, not Gauteng, which has twice the population, the Western Cape. Meanwhile, in Johannesburg, new house plans have collapsed 67% since 2015. Same country, same interest rate, completely different trajectories. That supply gap is about to become the story of 2027. Today, we also have an oil shock threatening to delay the rate cuts holding this recovery together. And remember to please like and subscribe to get notified when our intelligence briefings drop.
This week, the property market had to absorb a macro shock it wasn't expecting, Brent crude pushing past $92 a barrel. We're going to unpack what that means for the rate cut path, look at a tax change that is now live and could shift secondary market behavior, follow the money to the KwaZulu-Natal South Coast, and ask whether the student accommodation sector is heading for a two-tier crisis. Big week. Let's get into it.
Quick rate orientation, then the new development. Prime sits at 10.25%. Consensus pointed toward prime interest rate reaching 9.5 to 9.75% by year-end, a further 50 to 75 basis points of cuts from here. What has changed is the confidence attached to it. Brent crude reached $92.69 during the reporting period, with geopolitical commentary flagging a worst-case scenario above $100 if Middle East tensions escalate.
And if oil stays elevated, we get second-round inflation, fuel feeding into transport, food, and utilities. The SARB has just anchored to a 3% point inflation target. They will not cut into an oil-driven inflation resurgence.
Correct. The rand also depreciated 0.4% to 16 Rand 55 to the dollar by the end of the first week of March, partially reversing an approximately 7% appreciation we'd seen since the start of 2026. A weaker rand amplifies the imported inflation effect. And separately, the JSE All-Shale fell roughly 10% from its February peak, a risk-off correction following the index's 38% gain in 2025. None of this breaks the recovery thesis, but it introduces a timing risk that wasn't priced a month ago.
So the direction is still down on rates. The question is whether March 26th delivers another cut or whether the MPC pauses to watch the oil situation. That vote was already 4-2 in January. A minority wanted to cut then. The hawks will have more ammunition now.
One note for listeners, the SARB's formal consultation paper proposing to replace prime with a repo rate plus margin model remains on the table, transition no earlier than 2027, so all our rate framing stays in prime terms for now.
The capital gains tax relief that was previewed in the February budget is now live as of the 1st of March 2026. The primary residence exclusion has increased from 2 million rand to 3 million rand, meaning if you sell your home for a gain of 3 million rand or less, you pay 0 CGT on the residential portion.
The quantum is material. A long-term homeowner who bought for 2.5 million rand in 2005 and sells today at 5.5 million realizes a 3 million rand gain. Under the old regime, 1 million rand was taxable. Under the new regime, 0 rand is taxable. That's a potential saving of 140 to 180,000 rand depending on marginal rate.
So for the asset-rich, equity-heavy homeowner who's been sitting on a property through years of appreciation, this is a meaningful release valve. The downsizer demographic, people over 50 holding large freehold properties, can now exit with materially lower friction.
Here's the tension though. The CGT change incentivizes selling. It does not manufacture a capable buyer pool. If the oil shock delays SARB rate cuts, the leveraged middle-class buyer required to absorb a 3 million rand plus property remains bond-constrained. So capital released by downsizers is more likely to rotate into built-to-rent and premium sectional title retirement assets than back into the bonded purchase market. It's equity recycling at the top, not a broad stimulus.
And there's one trap worth flagging. If you've been claiming home office expenses, the exclusion only applies to the residential portion. The business use fraction remains taxable. Consult your accountant before you decide this gives you a clean exit. We want to get granular this week because the south coast of KwaZulu-Natal is emerging as the most analytically interesting geographic sub-narrative of this reporting period, and we haven't given it a proper segment before.
The price differential is the entry point. A one-bedroom on the KZN South Coast averages around 620,000 rand. A four-bedroom comes in under 2 million rand. Compare that to the KZN North Coast, 1.45 million rand for a one-bedroom, 5.35 million for a four-bed. Cape Town Metro, 2.2 million rand for a one-bedroom, nearly 12 million for a four-bed. The value gap is structural, not incidental.
And there are now infrastructure catalysts that make the lifestyle argument more credible. Margate Airport has daily direct flights to OR Tambo, which means a Gauteng professional can use the South Coast as a commutable primary residence. There's also a government announcement from late 2025 of a new small craft harbour at Port Shepstone. These are structural anchors, not just agency sentiment.
The market data is directionally consistent. Active listings in Pennington dropped 43% between September and December 2025. Single source, flag it. But combined with the price data and infrastructure investments, the signal is credible. Estate developments like Renishaw Coastal Precinct, a 15 billion rand project where existing Renishaw Hills values have appreciated 50% over 5 years, are drawing institutional-scale capital.
The demographic picture is also revealing. 79% of sellers are over 50, life stage supply release. The 36 to 40 buyer cohort is rising sharply. You have a silver economy supply meeting a young family demand. That's a real market dynamic, not just a vibe.
The caveat I'd apply: this is still primarily agency attributed as a semigration destination. We haven't seen deeds registry flow analysis that confirms net inflows from Gauteng. The directional signal appears credible, but treated as an analytically supported hypothesis until the hard transfer data corroborates. Tipping point risk also exists. The 43% listing drop in Pennington suggests price compression is already beginning in the most sought-after pockets.
The purpose-built student accommodation sector has a divergent story developing that we need to cover because it has direct yield implications for landlords and developers operating near university campuses.
Let's separate the two tiers clearly. Tier 1, Premium Private PBSA, targeting privately funded, missing middle and international students. The benchmark development this week is Harriet Reid's Fibonacci project in Mowbray, Cape Town, 574 beds, groundbreaking 6th of March 2026, with paddle courts, co-working spaces and retail anchors. This asset sits in a market where the central Cape Town node offers roughly 13,670 beds to serve a combined student population of approximately 75,000. Structural undersupply virtually guarantees occupancy.
Tier 2 is a different story entirely. These are private landlords and smaller operators who depend on NSFAS disbursements. The 2026 Metro accommodation cap has been held at 52,000 Rand a year. That's 5,200 Rand per month, paid over the 10-month February to November disbursement window, not 12 months. The Private Student Housing Association lobbied for a 6% increase. NSFAS said no increase at all, as 0% escalation.
Meanwhile, the housing and utilities component of CPI is running at 4.8%, so NSFAS-dependent operators have frozen income against rising costs. In high-cost nodes like Tishwane near the University of Pretoria, market rents already exceed the cap, and students are being asked for top-ups of up to 1,500 Rand a month. Students who can't pay are migrating to unaccredited informal housing, which then becomes ineligible for NSFAS subsidy, making the problem self-reinforcing.
The scale of the underlying shortfall is extraordinary. At the University of Johannesburg, approximately 100,000 students applied for accommodation against an on-campus capacity of just over 7,000 beds. The national shortfall is estimated at over 500,000 student beds. This is not a niche market problem. It's a housing crisis with an educational dimension.
One governance qualifier: NSFAS is operating under acting leadership for both the chairperson and CEO positions, with active SIU investigations into legacy financial issues. The direct payment reforms, bypassing the third-party intermediaries that caused delays in 2025, are a genuine operational improvement. But governance instability remains a systemic risk that any PBSA investor should factor into yield assumptions. There's the barb. Here's the number I can't stop thinking about. In high-demand Gauteng school feeder zones, TPN Credit Bureau data shows up to 51% of all school applications contain fraudulent residential address information. In one school, 40% of addresses fail door-to-door verification. That's not primarily an education story.
It's a spatial housing story.
Precisely. Because affordable, well-located housing near functional schools and economic nodes doesn't exist at scale, households are using shadow spatial arbitrage, faking an address to cross apartheid-era geographic divides. And what is the state's response at Soweto's Slovo Park informal settlement, where residents have been on the housing waiting list for years? Smart poles, street lights with free Wi-Fi and CCTV cameras. Residents formally rejected the project on the 7th of March and demanded the long-promised RDP house it instead. Over 1.2 million South Africans remain on the national housing waiting list.
So that 51% address fraud rate is actually quantifying something: the latent unmet demand for social housing and affordable build-to-rent in high-demand suburban nodes. Inclusionary zoning projects co-located near contested school feeder zones would face instantaneous demand absorption. The demand signal is there in the data, the pipeline is not.
The open question for our listeners: if technology spending is being prioritized over shelter delivery and residents are actively rejecting it, what does that signal about the social contract around housing, and what does a breakdown in that contract eventually mean for securities risk in social housing?
That's the ASA residential wrap for the 1st to 7th of March 2026. This week's key takeaways. The oil shock is a timing risk, not a thesis breaker. Watch the 26th of March MPC decision carefully. The CGT change is live and will move secondary market equity, but buyers need rate cuts to absorb it. The KZN South Coast is building a credible investment case, but verify with deeds data before committing. Student accommodation is splitting at pace, and the social housing gap underneath it all is larger than any single market metric captures. Next week, we're watching the MPC and the Cape Town tariff litigation. Thank you for listening.